I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing today?
I'm doing great. Thank you for having me on, Ross.
Yeah, good to talk to you. A lot of action in the Treasury market lately. A lot of pontificating about the move in rates, and I just wanted to get your take on the long end of the yield curve to start with. We've seen, take the 10-year Treasury kind of chop around a lot over really the last couple of years, press up against some key levels. Do you expect, the 10-year to continue to test 5% and potentially move through it? Or is the risk skewed to the downside for yields from here?
Yeah, well, it depends on what your time horizon is. If your time horizon is, let's say, the next 6 months, we've continued to argue that a weakening U.S. economy is going to be the biggest driver of the direction of yields. In particular, we do think that whether the U.S. economy faces a recession this year or not, we're definitely going to continue to see the labor market weaken. In fact, just today, you saw jobless claims, even though they didn't tick higher versus last week. Cumulatively, they keep pushing higher, and there's also further revisions to prior weeks suggesting the labor market is losing strength, and job losses are beginning to accumulate. Also, continuing claims also continues to rise, no pun intended. So you're seeing that the labor market is very clearly showing signs of destabilizing and becoming weaker. That will eventually lead to, in my opinion, a pullback in spending and a pullback in growth, and eventually a pullback in service sector inflation, which should prove to be more important for the Fed's mandate of stable inflation than the transitory goods inflation that we see from tariffs. All of that is to say that over the next 6 months, it's a better bet, in my opinion, that rates are going to push lower, 10-year yields pushing lower, in particular down towards 4% or even lower than that over the next 6 months. If your time horizon is longer than that, then all signs are pointing towards not only higher yields, but eventually 10-year yields above 5% by some point in time again next year.
Yeah, and if you could discuss some of the drivers you think, I mean, is that more about the debt and deficit and fiscal position of the US? Does that have to do with, a second wave of inflation, or is there a slight positive in there somewhere with, with economic growth or productivity, optimism around AI? Is it all of it together? Is there one key driver that you're watching?
No one key driver. That's part of the problem. It's almost like whack-a-mole. If you were to try to pull back on the inflation, you'd still have other issues that you see that would drive rates higher. To kind of summarize what's driving the long-term view of rates, the deficit, more so the deficit than the debt load. We always tell clients the deficit matters more than the debt load. The debt load, to the extent that it drives the deficit, the debt load matters. But it's really, you can't have $2 trillion a year deficits now, next year, 2 years ago. You just can't have them without moving the Treasury market. At best, we're looking at about $1 trillion of deficit over the next 12 months, and something like those levels again consistently over the next 2, 3, 5 years, although there is some room for a downside surprise. That is just too much for the market to digest without gradually pushing yields higher. So that's point number one. Point number two is that inflation. We talked about next 6 months, service sector inflation is likely to push lower as the labor market weakens. That is likely to reverse again as the economy begins to reaccelerate next year. And service sector inflation is really where the problem is. And the best way to think about service sector inflation, think about, we'll call it service sector jobs, your typical jobs that your average household holds. There is almost perpetual upward pressure on those wages because the labor market has shrunken, there's skill mismatch, and that's perpetually putting upward pressure on wages. So that is going to again begin to show next year, in our opinion, as the economy begins to reaccelerate. And then also real growth itself, positive growth, productivity growth, there's still a real yield impact from that that does tend to drive both short-term and long-term rates higher. So all of those forces are pushing Treasury yields higher. And then the other one that we just added recently is, if you're going to have a smaller goods trade deficit, that is, tariffs cause foreign sourced goods to become more expensive, and so we buy less of them. The counter to that is that foreign investors have less dollars floating around to push back into the Treasury market. Mechanically, that lack of flow back into the Treasury market, it tends to disproportionately hurt the US Treasury and the largest US states, It's not so hurtful to your average household as the media likes to say, but it is somewhat damaging to the Treasury's position because all those cheap goods that the US imports leads to dollars going abroad, and most of those dollars go back to the US Treasury and large cap companies in particular, not your typical household. So that is something that Treasury is also going to have to face. That is, in a world of a lower US trade deficit, there's lower capital to lower US Treasury yields. Plain and simple. Put it all together, and the picture for the next, we'll say 2, 3, 5 years is higher long-term yields. The picture over the next 2, 3, 5 months is shorter US long-term yields.
That was a great breakdown of a really complex topic. So I appreciate the time. Thank you as always, and we'll look forward to catching up with you again soon.
Thank you, Ross.